What's up, apes? Hope everybody had a phenomenal Tuesday here. I know that the Bank of Japan did because they officially kicked the bucket on negative interest rates, and that means every interest rate in the world right now is officially positive for the first time in way too long as well. So we'll be diving into that in just a quick second. Of course, we got some major stock movers of the day. Bitcoin took an absolute dive, so we'll be talking about that in just a quick second and how it impacted a lot of the digital currency stocks that typically trade alongside Bitcoin's price action. And we got some acquisition announcements as well in the biotech pharmaceutical industry. We are kicking cancer's ass, or at least trying our best to, and hopefully that goes well there too. Hopefully it goes good for shareholders as well. Then, of course, we'll finish up. You guys might have heard a little something about the NAR, the National Association of Realtors. They are going to be paying out a fat check to a lot of home sellers across the United States over the next 4 years. Welcome to the Daily Peel's video stream of the day. It is currently 7:17 p.m. on this beautiful Tuesday, March 19th, 2024. Welcome to the Daily Peel Global Headquarters. My name is David. Let's go ahead and get into it. So, first and foremost, we got to look at the market snapshot of the day. Solid day for the WSO Alpha portfolio once again. You know, I'm never going to be mad at a 35 basis points rise, but it's hard to be too excited about it when the S&P rose 56 basis points at the same time. But we did underperform the NASDAQ just barely as well. The NASDAQ rose about 39 basis points. So 2 days in a row underperformance. I mean, I'm surprised I haven't been fired already, but that's the situation that we're dealing with right now. We'll see what happens going forward, but a big reason for that is something that we're going to talk about in just a quick second, and that's the continual dive that Bitcoin prices have seen over the past week or so. They hit all-time highs. They crossed that $70,000, crossed even the $72,000 mark, and then it's been nothing but downhill since then, at least according to the price chart that I'm looking at right here. So we'll be getting into that in just a quick second, but that definitely detracted from the alpha portfolio on the day. You know, it's a small percentage, but it's a big fall, so it means a lot, even though it doesn't really mean a whole lot to the portfolio value in total. All right, let's go ahead and get into some of the banana bits of the day here for you guys. So the Federal Reserve is meeting tomorrow or today, depending on when you're watching this. Jay Powell, the Silver Fox himself, is going to come out at 2 p.m. Eastern time on Wednesday, spit some game about interest rates, probably make my head explode in trying to read through all of his quotes, understand all the Fed speak that's going on right there. But you know that we'll be summarizing all that bullshit for you guys on Thursday morning, so definitely stay tuned for that. Guys, March Madness tipped off today. I know that you guys are a bunch of gambling degenerates, just like myself and everybody else that I know. They are estimating about $2.7 billion is going to be run on just legal bets alone during this year's tournament. Keep in mind, guys, this tournament is less than a month long. It's about 3 weeks in total. It's called March Madness. It's actually going to finish up in April because, you know, a lot of people have difficulty counting things and labeling things properly. But like I said, $2.7 billion is expected to run on these games, and that's just illegal bets. If anybody's looking to place anything illegally, hit me up. You know where you can find my book. Then we got Microsoft. They're drudging up some old trickery in Silicon Valley, poaching players from Google's DeepMind team. I mean, hey, that's the name of the game. Google definitely is not going to be too happy about it, especially given that their artificial intelligence can't really determine if George Washington was white or black and other very basic mistakes like that. Probably not a good sign to have some of their most important people starting to flee, but nonetheless, Microsoft managed to scoop them up and really started to dominate the game right now. Then, of course, we didn't think it was possible, but equity sentiment is getting even higher, judging by this Goldman Sachs indicator. Be sure to check that out right there, because this could be getting into the territory where it's starting to be contrarian, and that we're all a little bit too excited on equity markets going forward. And you know what happens when we all get too excited? No result can be anything besides disappointing. So this could be kind of creating that last shoe to drop. I still have no idea what that phrase means, but the fact that expectations are created so highly, things can still be going well, but not good enough, and that can certainly lead to declines in markets. All right, that's about it for the banana bits. Let's go ahead and get into the big story of the day. Guys, it's officially all over, apes. The world of negative interest rates has officially ended, thanks to the Bank of Japan. Shout out to the Bank of Japan, the first time in 12 years that the entire globe doesn't have any one single negative interest rate on it. Now, I'm sure there is some cartel somewhere that's probably charging a small village negative interest rates, but in terms of national, actually legal, recognized by the UN kind of interest rates, there are no more negative ones going around anymore. So let's see what happened Tuesday morning in Japan, which is really Monday morning or afternoon for most of the rest of the world. I don't really understand time zones too well, but somewhere around that time period, the Bank of Japan officially raised their key short-term benchmark interest rate from negative territory up to 0% to 0.1%. No, that is not a joke whatsoever. That is the actual official rate. This is the equivalent of their effective federal funds rate. Guys, as a reminder, ours is 5.25 to 5.5% right now. The Bank of Japan is at 0% to 0.1%. And yes, that is considered tight monetary policy in Japan because over the past decade since the global financial crisis, Japan has basically had negative rates the entire time. I mean, this country has been falling apart since the 1980s, or at least its economy has, and it's largely due to demographics as well as things getting exported from them. Japan, they really burst onto the scene in the 80s with electronics, like gadgets like TVs, cars, and shit like that. But then when those started to get kind of exported around, it was really only Toyota and Toshiba, I think, is a Japanese company as well that are like the big players coming out of that island. But ever since then, the economy has been basically stagnant. I mean, that's pretty tough when everybody in your country lives to be 130 years old and nobody's having sex anymore. So there's not enough young people to actually support the welfare state that keeps those elderly citizens alive. They might have to be thinking about a new economic model going forward, because clearly it's not working out well to be carrying the team on the backs of young people when you have so many centenarians, octogenarians, whatever the word is for 90-year-olds, whatever the fuck. But essentially, because of the Japanese economy has been so disgustingly slow, the central bank had to do something crazy to try to spur some kind of a growth. So here in the United States, when the economy is starting to slow down, the Federal Reserve will cut interest rates. What that effectively does is increases liquidity, because it makes access to capital a little bit cheaper. When access to capital is cheaper, that means there's going to be more loan volume. When there's more loan volume, there's more economic activity because there's more money flowing around and more people can do shit to try to make more money. That's the name of the game with capitalism, and the idea is to make that lead to a little bit, pretty slow inflation, but higher economic growth overall and strong employment. That's at least the idea in theory. We all know that that happens way too rarely, but that's the goal at least. And so in Japan, they took that rate cutting experiment to the extreme and put rates through the absolute floor. They weren't the only ones to do it, but they were certainly the longest holdouts, and it's literally been since 2007 until today that this benchmark interest rate has been negative. Now, at its absolute peak, the total global amount of negative yielding debt reached as high as 18.38 trillion back in December of 2020. There was no growth going on at this time period, so it kind of makes sense. We'll cut them a little bit of slack at this point, but I don't know if I've explained my point just yet. I'm talking about negative interest rate debt. Guys, what that means is you deposit $100 in a bank at a negative 1% rate. 1 year from now, it's going to be at $99. You are paying this bank for the privilege of them holding your money. So you are depositing your money in this bank, and then you're paying this very sweet, kind, innocent, nothing but good banking institution for having the absolute privilege of holding onto your cash. It's one of the most ridiculous things of all time, but still, that is what Japan and many other areas needed to do to spur any kind of growth and get out of the GFC. For Japan, again, this problem goes all the way back to the 1980s, but we don't really have time to get into all of that here today. But essentially, like we talked about, when rates get taken to the woodshed, the goal is to kind of speed things up. But the question going forward is kind of, did this work? Let's go ahead and take a look back at some of this data in retrospect. So if we look at this graph of annual GDP growth in Japan, we can see that the 2010s weren't too different from the 2000s. So in terms of overall GDP growth, it didn't really have much of an effect. But then you pull up a chart of the exchange rate between Japanese yen and the US dollar. And we can see that from about mid-2015 through to the beginning of 2021, the yen basically did nothing but decline against the dollar. Now, that is a great thing for the Japanese economy, because what that's going to do is make their exports much more competitive. If the yen is falling compared to the dollar, then Japanese goods are going to be relatively cheaper when purchased in US dollars. So obviously, that's going to kind of spur GDP growth on the NX or the net export side of things. Now, clearly, when we look at overall GDP growth, the impact wasn't really enough to make just about any difference whatsoever. But the biggest impact came easily in early 2021. So we started to see a big change over here. Since the late 1990s, Japanese raises, like basically pay raises like the one that you've been begging your boss for the past couple of years, Japanese pay raises have been absolutely stagnant. They've been somewhere in the range of 1 to 2, maybe 2.1%. Then 2021, boom, it absolutely exploded with the Japanese reopening of their economy. This was in response to the post-COVID environment, as well as losing access to a lot of bullshit that they used to get from places like Russia and other agricultural goods from Ukraine. So these people actually had to start to work. And so raises started to come along with that because labor demand was so high. So the verdict is negative rates probably helped a little bit, but we don't really know. And if you ask me, this is far too risky of a thing with way too little evidence to show that it actually spurred economic growth to be a reliable pathway going forward. But according to economists who, are out here shooting the shit as they always do, just kind of blowing smoke a little bit, they said that, this is probably going to be something that central bankers keep in their back pocket, but probably isn't something that's going to be used outside of any egregious shocks coming forward. And, obviously we don't expect a shock, but that is the nature of shocks themselves, is that we don't expect them. So if a shock does come, don't be surprised if we see negative rates once again, but let's rejoice in this moment that they're finally gone. Guys, if we take a step back as well and start to look at the grand view of history, if we take, the 1,000-year view at interest rates, we can go all the way back to ancient Babylon and find clay tablets that have loans on them, and it says what the interest rate is going to be. Most of the time, it's something like 50 lima beans for, whatever the fuck bullshit, and some kind of agricultural cause. But if we go ahead and take a look at medieval Europe, the chart that I'm showing here goes all the way back to 1314. Yes, the year. I'm not just having a stroke. And we can see the global interest rates were somewhere in the range of about 11.5 to 16, 17, 18%. Since then, the trend of interest rates has been simply to just go lower. It's really been an asymptotic process, over the past couple of centuries, and it finally broke through that limit in the 2010s. I mean, to be alive for that moment is pretty remarkable. That is absolutely historic right there. So it is natural for interest rates to be lower because as economies develop, growth is going to be slower because you're building on top of a higher base in terms of the size of your economy. Growth is just going to be slower as that comes along. That's kind of the big grand explanation. We can get a little bit more into the weeds with it if you guys want to. But that is the general trend of interest rates. Go read The Price of Time. That is a phenomenal book that's going to be explaining it all. Plus, you can tell your friends you're reading a book about the history of interest rates, and I promise you, you will get bullied like you've never been bullied in your entire life. Not that it's happened to me. I mean, definitely not. But instead of talking about that, let's go ahead and move on to some of the major stock moves of the day. So we got Fusion Pharmaceuticals. Fusion Pharma, pretty sick name if you ask me. They were up 99.1% on the day. And there's only one thing that could be triggering that kind of action in the pharmaceutical sector, and that is another pandemic has emerged. No, I'm just kidding. They are getting acquired by AstraZeneca. $4 billion acquisition at $21 a share. That's basically double where the stock closed on Monday, so obviously the stock absolutely ripped. It's actually trading a little bit higher than that $21 per share because there is a $3 per share contingency on certain regulatory milestones being cleared. That's going to be the big thing for this. We'll see how Miss Walking L. Lena Khan actually responds to this over at the FTC. Now, the goal of this acquisition is to speed up the development to cure cancer. Personally, I'm all on board. Enough said. Let's not even look into this. Let's just trust them and see what the fuck happens. I mean, cancer can't get worse than it is right now, right? So I'm sure that the government is going to go ahead and try to fuck this shit up, but we'll see what happens going forward. Right now, it is going through, and it's a major milestone in cancer research development, because now we got AstraZeneca and Fusion Pharmaceuticals teaming up to do so, just like Moderna, BioNTech, and Merck have been doing it for a while with Keytruda and other cancer and COVID vaccine combinations. All right, then we got Nordstrom. I mean, Nordstrom Rack. Is there a better store on planet Earth for middle and high school boys trying to look way cooler than they are? Probably not, but Nordstrom, they are learning a hard lesson here this week. The primary goal for many startup companies is to eventually go public. And then once they go public and they're suddenly subject to the whims of 18-year-old traders on Robinhood, the main goal of most private companies is probably to go back to being private. And that's exactly what Nordstrom is trying to do today. They've realized their mistake and they announced that they're going to be trying to go private. Now, the company is working with Morgan Stanley and Centerview, companies that I'm sure you guys want to work for, to try to go private, but they got to gin up some interest among private equity players because the founding family, they don't have the cash to take this thing private. Who's surprised if you look at any rich family throughout history, it takes a couple of generations before they burn it all away on drugs, sex, whatever the fuck else it may be. So we're honestly surprised it lasted this long. They did make a similar attempt back in 2018 to do the exact same thing, and it didn't work out too well then, so we'll see how PE firms eventually make the call on this. Now, Supermicro Computer, they are in what's rotten 2 days in a row. Ooh, I don't know if you guys just heard that slack noise, but that has got to be the absolute worst sound in the world. So very sorry if I just triggered your PTSD like I just did to me. Just went ahead and muted my computer. But anyway, let's get back onto Supermicro. So 2 days in a row, this thing is in the what's ripe section. And yes, it's for two different reasons. But this has been one of the best performing stocks over the past 2 years. It's up over 2,000%. Most of that is concentrated between October and right about now. It's been ripping hundreds of percent, outperforming NVIDIA, Abercrombie and Fitch, and every other high-performing stock. This thing officially entered the S&P 500 on Monday, but it decided it wants to take advantage of that gain in share price a little bit here. So the company is looking to raise capital. They're looking to sell about 2 million new shares, and at the current trading price of about $1,000, that's going to get you $2 billion in total funding. Now the stock is back down to about 900, so that'll be about 1.8 billion. It's going to vary a little bit once the sale actually goes through, but obviously the stock's falling because this is dilutive to shareholders, but because the stock has ripped so much CEOs, executives, management doesn't give a shit that they're diluting shareholders because they're taking advantage of this insane rise to raise additional funds to, shore up operational processes, probably make some additional investments in foundries and other capital expenditures going forward. We'll see what happens going on there. Digital asset stocks had an absolutely terrible day, and it was all Bitcoin's fault as well. So as I sit here recording this video, let me open up CoinGecko. We are at $61,837.17. That is an 8.8% decline in the past 24 hours. Jesus Christ, I thought that was 7 days. But no, that is 24 hours. What if I switched this to 7 days? Yeah, Jesus Christ, that is absolutely ridiculous. It's not changing at all. So maybe this is an 8.8% drop in 7 days, but you guys know how CoinGecko kind of sucks at showing these charts. Either way, Bitcoin prices have been collapsing since the thing set a new all-time high. It's almost like there's no value or purpose behind this asset whatsoever, but that's not to say that there can't be eventually. We just all have to agree on it. Based on Bitcoin's track record, it's not off to a very hot start in that department. All right, let's go ahead and move on to the final story of the day. Shout out to any real estate agents out there. You are about to get really upset with me for talking about this kind of stuff, but let's go ahead and see what's going on here. I did totally just lose my spot on the page, so let me go ahead and scroll back up so I can remind myself of some of these numbers here. But the NAR is being forced to lower the bar. So there's a lawsuit that's been raging in courtrooms across America for the past couple of years, and it has to do with the National Association of Realtors and their completely anti-competitive business practices. Basically, what these guys did is go according to a code of ethics where real estate agents kind of work together, and according to this court determination, they conspired to keep commissions high on home sellers. Basically, in the United States, the way that the home buying and selling process works is that it's kind of all run through this site called the MLS, or the multiple listing service. So in order to access the site, you need to have an active real estate license. And so in order to do so, in order to find a lot of the good options for homes, home buyers would have to go to a home buying agent to look up on the MLS and find what options there are. Now we have things like Zillow, Praise Be. Go check out our reporting on that as well. But now that we have tools like this, there's much less reliance on buyer agents. And so the old industry norm where the seller agent would guarantee a certain amount of money to the buyer agent as part of that contract is getting thrown out the window. Basically, what would happen here is home sellers in the United States pay a commission that covers both the seller agent and the buyer's agent. So the buyer's not paying the agent whatsoever. It's entirely done on the home seller. And that's who this lawsuit was kind of plaintiffed by. It was by home sellers over the past couple of years across the United States. Big class action lawsuit. And ultimately, the NAR is going to be paying out $418 million in a total settlement. Plus, going forward, it is no longer allowed for home sellers and home seller agents to make a guaranteed commitment of what the home buyer agent is going to be receiving throughout the entire process. This allows home buyers to then negotiate what they want to pay the home buying agent. And it also allows home sellers to only have to pay the commissions for just one of the agents involved in the transaction. Definitely a solid solution. The United States has absolutely ridiculous real estate commissions in the 5.5–6% range for the most part. Most other places around the world are around 1.5% to 3%, which, if you ask me, is still absolutely absurd. You can go online and sell $1 million of stock right now for $5. It might even be free at some services, but if you want to sell $1 million property in the United States, you're paying $60,000 for that. And I know that it's different. There's a lot of paperwork, legal fees that go on with it, but why wouldn't you just hire a lawyer to do it? Because at least you're not getting that additional commission from the real estate agent that isn't really doing too much work. Please send this to your real estate agent friends so that they can get nice and pissed off about it. They also might need a couple of bucks, so maybe hit their Venmo as well. But if they still want to work in finance, of course they can. Just go ahead and tell them to check out the WSO Academy and we'll get them set up all right. All right, guys, that pretty much about does it for us here today. Of course, Mr. Ray Dalio with the quote of the day. We had to go to interest rates. We're using his famous line. It all comes down to interest rates. As an investor, all you're doing is putting up a lump sum payment for future cash flow. So it just totally depends on the interest rate that you're going to be getting on that. Now, the interest rate he's talking about in that context is returns, but still, definitely a great quote for us because we have officially rid the world of negative interest rates. All right, that about does it for my purposes here today, guys. Hope you had fun peeling back markets with us once again. I'm actually going to go ahead and eat one of these bananas. Like I said, I will never be doing this on camera because I can only imagine the meme format that you degenerates will be creating with that, and I don't want my mother to see that kind of explicit content. But either way, thanks for joining us here today. Hope you guys are having a great start to the week. We'll see you again tomorrow. Happy investing, happy trading. Bye now.
And thanks to you, my listeners at Wall Street Oasis. If you have any suggestions whatsoever, please don't hesitate to send them my way, Patrick at wallstreetoasis.com. Until next time.